Yes, Amit.
Yeah. Good evening, everyone. I welcome you all. I welcome RCM Ketan by Saiya ji, our own member of Dadasiri Sapri Circle. On behalf of Dadasiri Sapri Circle, I welcome everyone, and I welcome for the today's program on bank audit. And before we formally start, I will request Parin to play the ICI motto.
Justice.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः तदेव शुक्रद ब्रह्मा तद ब्रह्मा मुच्यते तस्मिन् लोकः सर्वे तदूनात्यपि कश्चनात्यपि कश्चन एतद्द्वैता एतद्द्वैता एतद्द्वैता
Thank you, Parin. Thank you very much. Friends, you all will agree, of late we have been seeing a lot of hammering on our attestation function is going on. There are a lot of questions, a lot of doubts are being raised of late on audit quality. The expectations of the stakeholders are very high now, and it's high time we gear up ourselves. We ensure that we whatever attest are with the proper due care and due diligence, and we try to meet the expectations of stakeholders. Otherwise, whenever it not be a time when we'll be out of profession, and we have seen this lot of new industry, new institute, and all that being formulated for accounting profession. Especially when we are doing an audit of a bank, when a lot of public money is involved, it is very important we do proper care, and we ensure that proper documentation are being maintained. And to throw a light on those aspects, we have very eminent, and I can call guru of bank audit, our own member and RCM Ketan Saiya ji. I welcome them, and we have a very knowledgeable person, Jay Gosar, who will be taking over on the various provisions and the amendments which are there in the banking audit. And I hope everybody will get full benefit out of them. Before we start, I would request Deep Chheda to formally introduce Jay Gosar.
Thank you, Amit Bhai. It is a pleasure to introduce the speaker and the chairman for today's session. Our speaker for the day, CA Jay Gosar, is associated as senior manager with Khimji Kuvarji and Company since September 2019, and he has been focusing only on assurance, audit, and advisory services for banks and NBFCs. He has a vast experience of handling large corporate banks, Indian branches of foreign banks, and large and medium-scaled NBFCs. Before joining Khimji Kuvarji and Company LLP, he was previously associated with Deloitte Touche Tohmatsu for 2.5 years with their M&A vertical, and his primary focus was on financial due diligence of large-scale NBFCs on the behest of private equities and venture funds. We welcome Jay Bhai as the speaker of today's session.
Thank you, Deep. Thank you and welcome, Jay. Well, Jay is also a member of our own Dada CP Circle, and it will be a privilege to listen to him. Deep, I would request if you can introduce our own RCM, Ketan Bhai Saiya.
Yes. Ketan Bhai, we welcome you to our study circle. Ketan Bhai has been recently elected as RCM of WIRC and holds the prestigious post of chairman of Vikasa, which is the student wing of WIRC. He is also the managing partner of KDS and Company and the past convener of Dadari CPE Study Circle. Along with that, he has been a regular contributor to the guidance note issued by ICAI on the topic of bank audits and has been a regular speaker and author of various articles on pan-India forums and especially on the topic of bank audit. And in my view, I don't think there are two better speakers today. As rightly said by Amit Bhai, the attestation function of chartered accountants has never come under as much scrutiny as it is coming off late. And I really sincerely believe that we have the two best people right now with us to give us guidance on LFAR and the bank audits and what are the repercussions of the latest changes that have been coming across. So I now hand over the floor back to Amit Bhai.
Thank you, Deep. Friends, you all know that a lot of things are becoming virtual nowadays. Audit is becoming virtual. Programs are becoming virtual. Looking at this, I would request Mehul to give a virtual certificate to the today's speaker as a love of affection and.
Thank you, Amit. Pareen, can you share the? Yeah. Thank you. Jay Bhai, we are. Please accept this virtual certificate today for agreeing to present. Act as speaker today on the topic of bank branch audit. It is indeed a pleasure to have you today with us, Jay.
Thank you so much, Mehul Bhai, and thank you, Amit Bhai. Should I begin or?
We would like to give a certificate to Ketan Bhai also. If
Ketan Bhai, please accept this e-certificate today on behalf of Dadari CPE Study Circle for agreeing to act as a chairman today for this topic of bank branch audit.
Thank you, Mehul and the entire team of Dadaris.
Thank you. Sir, now the floor is yours. I'm sure the benefit to participant will be anonymous, and I hope everybody will have a pleasure learning. Floor is yours, Jay and Ketan Bhai.
So, Jay, you can start the talk. And before Jay starts the talk, let me mention that, the Amit said that it is going to be virtual. Yesterday he attended, like he should, is, planning to come with the guidelines wherein there will be 50% virtual and 50% physical program happening. So the overall feedback, there are advantage and disadvantage of, holding virtual meeting, because as of now also we see 99% of the people's cameras are off. So we don't know they're really listening or they're just, taking CP. And this year, the council keep assigning various duty. And this year, one of the role which is assigned to me is, I'm chairman of the study circle coordination committee, which is, looking at the administration of all the study circle across the region. So one of the debate which we are having at the council is whether, to continue with VCM or to, convert it or to keep 50% physical and 50% VCM. Some sort of other guidelines will come. Be it as may be, I've gone through the presentation prepared by Jay, and it is one of the excellent presentation. And so without taking much of time, I'll request Jay to begin with that. And wherever if something is to be added or something is to be, said, I'll definitely chip in over there. And I'm sure that will not be required. I'll just have to be here. That's it. Otherwise, it's an excellent presentation, and looking at his experience in banking, I think he will easily, smoothly, handle this entire study circle. So over to Jay, over to you. Please start.
Thank you so much, Ketan Bhai, and thank you, Amit Bhai, Pareen, Mehul Bhai, and everyone, for such a warm welcome for the today's study circle. And thank you, Deep, for such a lovely introduction. I'll just keep my video off for some time because there's some net issue. So once I think we start with the presentation, and if everything sails through, I'll keep my video on. Let me know if you can see the screen, and then we can start with the today's discussion.
Yeah, it is. We can see the screen.
Sure. So I think how Amit and Ketan bhai, I think both of them have rightly mentioned. I think in today's scenario, banking industry has been one of the most ever evolving sector, perhaps in the global economy, and more so in the Indian economy per se, because the way the overall banking habit has changed drastically in last 2.5 years. I'm 100% sure that there are more and more additions that are going to come forward in the entire banking scenario. Just a simple example is that before COVID, whenever we used to go to the markets, where we used to go to buy some very small items from a very small stall vendors, or from some local vendor, we only had one mode of payment, that is cash. But today, everyone, right from a fruit seller to a small pan shop, everyone has a UPI code or QR code to make digital payment as one of the most easy way of doing any transaction. So UPI transactions, digital banking, and creating an awareness on how technology has played a very key role in bringing a paradigm change in the entire banking scenario in last 2.5 years has been clearly demonstrated in front of us. Specifically adding to that is the overall UPI transactions at a global level. India ranks number one in terms of the total transactions that have taken place through UPI. Simultaneously, there are other aspects in the banking industry which are kind of evolving, and which are going to come at least in next 1.5 years, mainly being the cryptocurrency and the bitcoins and the Beyonce coins, which are going to hit the Indian market very soon. To keep all these updates in check, RBI has been very pragmatic in terms of bringing out new guidelines, such as updating their AML and KYC guidelines, asking the banks to submit different kind of returns of information with respect to, say, excess cash withdrawals, obtaining PAN details with respect to high value transactions, levying TDS with respect to interest on bank deposits, etc., where the Indian market has kind of easily sailed through the COVID scenario. In the earlier part of COVID, definitely there was a lot of traction in terms of how the credit and credit evaluation, credit enhancement, and overall credit supply was kind of regulated in the Indian market. But sitting today, when we have done the audits of all the large corporates for last 2 or 3 quarters, we have definitely seen a rise in the credit disbursements in terms of the overall disbursement cycle coming to the pre-pandemic level. And at the same time, RBI has brought a huge shift in terms of the overall operations of the bank in last 1 year, I'll say. Again, in terms of having different kind of updates for NPA identification, NPA automation, having new guidelines with respect to having a single current account, or regulating your current account operations. The guidelines, the overall landscape is definitely changing, but at the same time, there is a onerous responsibility on the auditors to ensure that we, as one of the stakeholders and one of the line of defenses in the entire ecosystem, we give a very quality service to our clients, to the banks. And in this scenario, having this kind of discussions where branch audits, and where our role in terms of regulating and monitoring the overall branch operations, and converting that in form of a audit report and in form of a LFAR is equally important. And I hope that this presentation is helpful to you all. I'll want every one of you to be very kind of please stop me anytime if you are having any queries. Let's make this session very interactive. And if there are any other opinions that you have which are different from mine, or which are kind of something that needs to be discussed, please feel free to have this platform as one of use this platform as an opportunity, and let everyone be benefited from this. So let me first, one second. Yeah, so let me first set the structure of the today's discussion. We'll be first having a very basic discussion on the entire banking landscape. Second discussion will jump onto the most important aspect of our branch audit, which are the advances. And then third, we'll have a discussion on the other matters which are reported in LFAR, and we'll try to have discussion on the updates that have been made in the LFAR reporting via 5th of September 2020 circular, where there are new or additional items that are to be reported in LFAR. So again, a very key characteristics of the bank, if I have to say, so all banks in India are now governed by RBI Act 1949 that you are aware of, including the recent amendment in September 2020, where the cooperative banks are now brought under the direct supervision of RBI. So earlier, the cooperative banks were under joint supervision of RBI and the local state registrars as well. But now urban cooperative banks are directly under the supervision of RBI, just to ensure that the financial health of the cooperative banks are now in check, and the cooperative banks, the operations of the cooperative banks are not misused by any influential person who is kind of operating in that area. Apart from the Banking Regulation Act, the overall day-to-day operations of the bank are regulated, are monitored by different master directions, master circulars, which are announced by RBI from time to time, along with the required clarifications that are issued by them. Again, a very simple characteristic is accepting deposits for utilizing it for commercial lending or for making any treasury investments. But I'll say definitely this something has kind of changed and evolved in past 1.5 years or 2 years. The conduct of the banking operations traditionally used to be at a very decentralized, used to be at a centralized level. But now a very mixed approach is being followed by majority of the nationalized banks, private banks, and all my large scheduled commercial banks, where the branches are set up to do a client servicing activity, to collect the documents, to resolve the queries of the bank, where these branch employees are the face of the banks for their customers. But once they collect the documents, all the documents are sent to some kind of zonal or regional repository or regional processing center, where the actual operations in terms of account opening or credit evaluation or reviewing the document happens at these levels. And definitely the dependence on technology has increased because of the high volumes and high degree and high volumes of the transactions that we have seen in past few years. So this is the banking structure where we are currently looking at, where there is a head office, and then there are corporate office. There's a corporate office which looks after all the functions of the bank except for treasury, because generally treasury operation of the bank, where I say monitoring my investments, monitoring my derivatives, and monitoring any call money or any similar operations are usually maintained at a head office level. Those rights or those operations are not passed on to the branch level. Below a head office or a single national head office, there are different zonal or regional offices, and then under them there are different type of branches. And I am sure the branch audits that we as chartered accountants are getting to audit or will be auditing in this financial year will be more or less following the similar structure. So what are the key expectations from bank auditors? Number one, or branch auditors, number one is access to the closing instructions issued by the head offices to the branches to assess them in error-free closure of the account. So definitely there are guidelines which are issued by the head office to ensure that the accounts are closed on a timely manner and are closed in a very systematic way based on the instructions given by them. We as statutory auditors of the branch should have access to these closing instructions, because definitely there are certain key adjustments and key entries that are passed at the end of the year to close the books of accounts, and we as auditor have to review those entries and those transactions which are getting affected into the accounting system. So yes, access to this closing instructions by the auditors is a must. Second is, given the timelines that we are speaking of, so we before the meeting started, we were having discussion internally as well, where many of us have still not got the appointment, or we have not got the confirmation, or that appointment process is still in still we have not completed, and where the expectation from the central statutory auditors here is that we have to close the branch audit by 18, 19, 20, or maximum by 22nd or 23rd. So keeping those timelines in mind, framing our audit plans vis-a-vis the requirements of the LFAR review of the advances and everything are so important that we should ensure that we stick to our plan, we deploy our resources accordingly, and we complete the audit in a quality and a timely manner. Third, knowledge of core banking system or IT's or bank's IT system. Definitely, when banks, when we come to a huge scheduled commercial banks, everyone uses a core banking system like Finacle, or someone will have a FlexCube or some other kind of software. We should definitely have a knowledge of core banking system. Yes, we may not be able to access it very fully, but at least taking assistance of the branch managers or branch team, we should be able to access to certain basic Finacle codes or FlexCube codes, where we can review the ledgers on our own, or we can extract the repayment schedules on our own, or we can monitor, or we can see how DP limit versus my utilization is getting captured in Finacle or monitored in Finacle. So having these kind of basic knowledges is very helpful, and definitely given in today's time, all these material is also available online widely. If you put basic things on YouTube or on Google, you will definitely find a good reading material or a video material to look into before you kind of start with the audit exercise. Again, here on the third point, there is a important guideline and circular which has been issued by RBI, which is a key update for the financial year FY 21 and 22, which will be looking into in the subsequent slides. Yes, we should be updated with the important master directions, master circulars, and whatever clarifications are issued by RBI. And having a knowledge of that is a must, because given in the COVID scenario that we just passed from, the directions are very much ever evolving, and gone are the days where a single IRAC circular kind of drove our entire audit strategy or audit checkings. Definitely, there are multiple circulars and master directions we have to refer to simultaneously to ensure that bank or a branch complies to those guidelines. We as auditor are definitely expected to verify and ensure on the correctness of the classification of assets as per the IRAC norms. Next is on correct reporting of memorandum of changes. Memorandum of changes, I think all of you must be aware that those are the changes that we suggest as an auditor basis our review or basis our audit of the books of the branches. So whatever changes that we are suggesting, if there is any accounting entry that has to be passed as a part of this memorandum of changes, we need to ensure that yes, we pick up the correct items to be passed or to be recorded under memorandum of changes, and a correct accounting impact is given for those changes, because memorandum of the changes of each branch auditor will be compiled at a HO level, will be reviewed, and then accordingly those numbers will be affected will also have an effect on the overall financial position of the bank. So yes, as a branch auditor, we are very much responsible for ensuring the correctness over here. conducting our audit bearing materiality in mind while adopting a conservative approach. Materiality is a very key thing when it comes to bank audits, because the numbers are such that for us, those numbers might look very huge, very significant, but in the overall scheme of things, those numbers, maybe those numbers may have a potential adjustment impact, but those numbers will not be material at an overall level. So conducting our audit, keeping materiality in mind is very important. If we have a chance where you can have a discussion on this materiality aspect with the central statutory auditors before you start the audit, if that can take place, then nothing like it, because a lot of changes, a lot of audit procedures can be managed using materiality as a number. But at the same time, we need to ensure that we adopt a conservative approach while reviewing the asset classification, provision, and income recognition, because there is no relaxation or leeway given by RBI that if there is a wrong asset classification or a wrong provisioning calculation that has been done, if that is not material, then you can kind of skip it and not discuss it or not inform it to the management and to the auditors. So yes, it's a mix of using our materiality and using our conservative approach. Next is on testing of the internal controls. Internal control over for the financial reporting aspect, where we may not be directly liable over here, where the central statutory auditors have the primary responsibility on reporting on the IFC aspect of a company or of a bank. There might be certain communication which you may receive from your central statutory auditors or from the bank management per se, where we have to test the internal controls and comment on it. So in the overall audit strategy, this should also form a part of my audit plan. Next is what is LFAR. Again, a very crucial document for us. It's nothing new, or it's not a new reporting for us. LFAR is again a question or a checklist format kind of a reporting, where several matters which are not to be included in the main report can be but which are considered important to be communicated to the management can be reported in LFAR document. Definitely, though, when I say reporting under LFAR, we also need to test whether those observations can have a bearing impact on the overall opinion that we form or develop for the branch audit. It is a type of a management letter where there are certain questions which are given by RBI or which are directed by RBI, and we need to fill up the responses to those questions basis of a discussion with the management or basis the audit activity that we are doing. The objective is very clear over here, is that whatever information that we are updating in the LFAR, the management, the regulators, and the central statutory auditors will use those inputs on kind of framing an overall opinion on the effectiveness or on the compliance related aspect of those branches. So reporting under LFAR is a very important aspect of the overall audit plan. How this objective can be achieved, it's a very simple, or it's very simple to look into, but definitely it is a detailed procedure where verification of the data inputs, verification of data integrity, which means the correctness of the data, verification of internal processes and controls, transaction testing, testing of the processes, highlighting the weaknesses observed, and qualification in the main report, if any. So whatever questions are guided in the LFAR, the responses that we update in the LFAR will form a basis of our qualification in the main report as well. What are the areas that are covered in LFAR? So generally, from asset liability and profit and loss point of view, all the areas that are having a bearing impact on the preparation and reporting of my balance sheet and P&L, all the areas are covered over here. In addition to that, the RBI also expects from us to report on the gold and bullion transactions, which is a newly added point in this LFAR. Comment on the overall books and records which are kind of maintained, frauds that are reported, implementation of my KYC, AML norms, MIS, and any other miscellaneous questions which are forming part of, the LFAR scheme. The LFAR has been updated on 5th of September 2020. I think everyone would be aware because last year also we would have taken the same LFAR as a base. The LFAR is quite exhaustive, and at the same time, it has been prepared in such a way that we as an auditor try and cover maximum area or maximum branch operations in this entire audit activity. If there are any questions over here, I'll pause for a minute and happy to address them, or we can move to the next section. Fine. I'll move to the next aspect of our today's discussion, mainly the advances, because advances are one of the key pillars of my entire banking operations, which drive the branch operations as well. The approach that we adopt in doing the audit of the advances is very subjective, because whatever has been written over here is again in terms of the guidance which is available in the different reading materials that we have. It has been compiled based on our experience of how, what kind of documents, what kind of quality of documents, what kind of queries, what processes are available with respect to the banks that we have audited. Definitely whatever discussion or whatever information sharing that will happen on advances over here, it can be taken as an input, but depending on the overall operations of that particular branch that you will be auditing, the approach can be suitably modified to achieve one end goal, is that we should be able to form a proper opinion on the entire branch operations. So the extent of the approach would definitely depend on the assessment of the efficacy of the internal controls. When we start the audit of the advances in the branch, I think that will be the first thing that definitely one part of our team that will be looking into. It will be very prudent for us to, if we are not doing the audit of that branch, if we have not done the audit of that branch before or of that bank before, it will be very prudent for us to understand the entire credit underwriting process in detail. So right from a loan is sourced to the time a NPA is identified, what processes are taken by the branch, what processes are taken, say by HO and by branch, or if there is any other vertical that is involved in the process which is not available in the branch. I think the entire activity needs to be discussed, understood that what level of operations are controlled by the branch and what are not. It is very important because whenever we'll start giving our queries, or if there are any observations that are to be discussed with the branches, if we believe that okay, we will compile all the observation and discuss at one go with the branch, it may also possibly happen that branch will not have answers to all the questions readily, because definitely certain aspects or certain processes being taken care by some other team. So in this situation, having a clarity on the entire underwriting process is very important, so that if there are any significant queries that are coming up during our assessment, and we know that branch may take time to obtain responses for them, it will be very prudent on our side that we highlight those questions on a timely manner upfront to the branches, rather than waiting in the end. Next aspect would be that examining or reviewing all the existing large advances at the branches as of 31st March 2022. There is what is large advance has been defined by RBI under LFAR, but definitely when you will be looking into the portfolio report of that particular branch, where you will be getting the list of the outstanding advances and what is the exposure with respect to those advances, both fund-based and non-fund-based. It will be important that we also decide at our stage as to what constitutes large advances. Definitely, it cannot be less than what RBI has suggested under LFAR. But if we find some cases which are falling below the limit, but those cases belong to certain industry which we feel is already troubled because of some internal or external economic factors, or we find certain names which we know that based on the information available in public domain, this is a very troubled case that needs to be looked into. Yes, we need to look into those advances as well and assess whether that can form a part of the LFAR reporting as well. Review quarterly Acrylic report with respect to the specific advances of the branches. Can anyone kind of tell me what is Acrylic report? If we have done branch audits before, Acrylic report is one of the most important, I will say, return that needs to be reviewed by the branch auditors. Can anyone highlight me on that? Maybe Sanjay bhai or anyone? Let's keep this more lively. If anyone knows about Acrylic, anything, it will be really helpful. Ketan bhai, you would like to chip in over here? Hello.
Jay, so one participant has responded in the chat box, and Ketan bhai seems to be on call, so he's not able to join.
So definitely, I think someone has responded. Yeah. So Central Repository for Information of Large Credits. So every bank has been mandated to report on the performance of the large credits or large advances, specifically more than 5 crores, to a central repository or a central agency called as Acrylic, where they need to, kind of report on the performance of those advances. Specifically, where why this reporting becomes important is that Acrylic reporting includes something called as SMA flagging or SMA tagging, which is special mention account. When we get the Acrylic return from the branch or from the HO with respect to the advances of those particular branch, while we'll get a very holistic detail of all the borrowers over here, what is the fund-based exposure, non-fund-based exposure, what is the exposure available with the other banks and everything. If there is any NPA reporting done by any other bank, we can get that detail from this report as well. SMA reporting done by our branch becomes also one of the key input for us to look into, to select or identify those specific advances. Because SMA, I think everyone will be aware, are SMA tagging or SMA cases are those cases where the borrower has started showing a signal of weakness or a deficiency in that aspect. So if there is a default by 1 day from 0 day to 30 day or 1 day to 30 day, it will be tagged as SMA 0. If there is a default from 31 to 60 day, it will be tagged as SMA 1. If there's a default from 61 to 90 days, it will be tagged as SMA 2. So if I get a quarterly return or a quarterly detail of my large advances under this Acrylic format of Acrylic report from the branches, we will get a very clear-cut picture with respect to what has been the delinquency positions or delinquency details of those particular advances, if any. So if, say, for example, if XYZ company is under SMA 2 category as at December, and if the same XYZ company is under SMA 0, or say if there is no delinquency at all as at 31st of March or even before that, then in that case, definitely that particular advance, if it is a high exposure or a high value advance, it becomes very important for us to review, because something triggered for that advance to or for that borrower to not pay, and hence that he defaulted for more than 30 days or 60 days. But suddenly that borrower has kind of arranged the money and ensured that all my overdues are paid, and hence there is no delinquency position or no default position as at 31st of March. Then those advances will catch my attention definitely, to understand from where did that borrower arrange the money, how did bank ensure that those are my genuine credits which are kind of coming into the account to be utilized for making the repayments, etc. So reviewing the quarterly Acrylic report, or even if there's even if you don't get any Acrylic report handy, but if you can get your DPD positions or DPD details, days past due or my default details at the end of every quarter for all these branches, I think it will be very important tool for you to identify some special advances to be looked into. Verify the fresh advances granted during the year. Again, for all the new disbursements that have happened during the year, or if there has been any enhancement given to any existing borrowers, definitely we need to verify whether the fresh advance or the enhancement that has been given is it in compliance with the RBI guidelines as well as the internal bank guidelines, going back to the underwriting process that we should discuss upfront. Verify the advances which are adversely commented by the previous in the previous audit report or in the LFAR. If there are any adverse comments in the internal audit or concurrent audit report, adverse comments in bank inspection report, or maybe some or the other inspection report, that is HO inspection report or some other inspection report which is available. Reports on verification of security. So if there are any adverse comments in my stock audit reports or my valuation reports, that becomes a key thing. If there are any adverse comments in the exchange of information report from a consortium or a multiple banker. So say if a loan has been financed, if a loan of XYZ company limited has been financed by a consortium or a group of bankers together, or XYZ company limited has availed banking facilities from different banking entities, those will form a consortium or multiple banking channel for this borrower. So definitely, as mandated by RBI, there is quarterly exchange of information that happens between all the bankers with respect to these kind of borrowers. So in the quarterly exchange of information, there is a single or a two-pager format which is suggested by RBI, which speaks on the what are the exposure details, whether there was any SMA reporting done in the previous quarter, whether that account has been tagged as NPA by any of the borrowers, because it can be a possibility that some account has been tagged as NPA during the quarter, and if it is a consortium bank, yes, those the lead banker is mandated to inform it to all other bankers. But if it is a multiple banker, he is not mandated to inform about that NPA reporting to any other banking entities. So in that case, reviewing this exchange of information report or a letter becomes very important, because sitting today we may not know if that particular borrower is a NPA case with any other banking entities. Branch managers charge handing report, branch control returns to the higher authorities, specifically concerning on overdrawing, ad hoc sanctions, probable NPA reports, etc. There is something definitely called as red flag accounting or early warning system that is put in place by many of the bankers. Typically, they call it as EWS mechanism. So early warning mechanism is has been put to identify those chronic cases which may turn into NPA, which has the potential of turning into NPA. But if those cases are identified beforehand, the banks can take action on those cases to arrest the slippages slippages in the asset classification. So apart from the Acrylic reporting, the SMA reporting that we spoke about, there are early warning mechanisms which are put in place by the head office team, and there is an early warning EWS reporting that is done maybe from bank to regional or to HO, or there might be some regional team that will be looking into it, and they might be informing the branch about this EWS cases beforehand. So having discussion on red flag accounts or EWS reporting will definitely help you to identify if there are any advances where there is a possibility of slippages, or even if those cases are potential NPAs, or there is a high possibility that account will turn into an NPA, and if there is some different kind of practices which has been adopted by the branch to arrest the slippages, which may not be correct, having those cases reported from a head office team and having those cases reviewed independently by us will help us to keep in check whether any wrong practice has been adopted by the branch to avoid the wrong asset classification. Next, our approach should be to review all the accounts that are upgraded from NPA to standard category with respect to full recovery. There is a significant update that has come with respect to this in the current financial year. We'll speak about it in the next slides. But yes, when you upgrade a loan from an NPA classification to a standard classification, definitely this will lead to reversal in the provisions, which in turn helps the bank or benefits the bank in terms of the entire profitability position. So you should definitely get a list of the accounts that are upgraded from NPA to standard category, how they have been upgraded, and whether that upgradation has been done correctly or not with respect to full recovery of the overdues. There can be a possibility where NPA, once an account turns into NPA, these cases are specifically looked by some NPA recovery team, which sits at a regional, zonal, or at a head office level. So if you're asking for this particular information and if it is not made available to you, or if this is the response that you are getting, maybe you can update this in your LFAR, or you can compile this as a discussion point with your statutory auditor, so that before closing your branch audit, you can ensure that whatever responses given by the branch is correct or not. Next thing is on verifying the compliance of restructuring norms and its asset classification. Restructuring has undergone a paradigm change even before the audit, before the COVID-19, and even during the entire pandemic period, there have been various updates with respect to the restructuring of MSME and a non-MSME loan category. So definitely, whether the bank is complying with respect to the norms which have been issued by RBI with respect to the restructuring of these cases, as well as its asset classification. So that needs to be looked into specifically. A key requirement here to be asked from the branch is that you can tell them, please give us a list of all the cases that have been restructured during the year under the resolution framework of RBI, COVID resolution framework of RBI, which was done in the last year and even before that, and whether whatever asset classification has been maintained. So if it is a standard case and I'm maintaining a standard classification, or if it is a standard case and now it has slipped into a NPA classification. On a sample basis, you should definitely check whether the control procedure or control processes in terms of this asset classification and the compliance with the RBI guidelines has been done correctly by the branch or not. Evaluation of control with respect to the advances. I'll quickly run through this. Existence of a clearly laid down delegation of authority. So whenever you are verifying new advances, so where there has been a new disbursement or an enhancement in the disbursement, definitely ask for delegation of authority, and whether make delegation of authority matrix, and whether whatever approvals are received with respect to those cases, whether it is in terms of this delegation of authority or not. If there is an override with respect to sanctioning of the loan, then yes, that is a red flag indicator for you to check whether that advance has been correctly assessed and correctly approved or not. the branches will definitely have the list of the approvers for all the fresh disbursements. So whenever you will be taking the list of all the fresh disbursements and enhancement during the current period, definitely ask from them, please give us the list of the authorities or details of the authorities who have approved this loan. Typically, it is always there are certain parameters or certain thresholds involved, with the highest threshold being the credit committee to sanction these kind of loans. But when we have some retail portfolio, or when our branch focuses on retail portfolio, say housing loan or some kind of personal loan or some two-wheeler or auto loan, definitely there might be a lower delegation of authority available with some individual or with some group of individuals. So whether that delegation has been correctly followed or not, existence of clearly laid down eligibility criteria for the loans, we'll discuss it in the coming slides. Existence of system of communicating the terms of sanction to the borrower, which means that there has to be a proper sanction letter that is executed. Loan agreements are properly executed, defining the terms and conditions. There has to be complete transparency in terms of the specific terms and conditions, covenants, or whatever conditions are being laid down by the bank, that are clearly communicated to the borrower, and with the borrower's signature on those accounts or those documents, it reflects that borrower has read those communications or conditions and he has accepted those conditions. Existence of system of execution of documents before disbursement, and existence of system of post disbursement monitoring, so after disbursement. So here definitely we need to understand what level of controls are in place to ensure that whatever mandatory documents are required to be signed and executed with the borrower have been executed before the disbursement request has been received. So there should not be a case where I can see that the date of disbursement in my disbursement listing is some X date, whereas the sanction letter or say the loan agreement or any other document bears a date after the disbursement. There is again a relaxation or a general nuance or general what you call process that is followed, is that any of the mortgage documents, say, or the security creation documents with respect to my immobile properties, which kind of generally takes time in executing those documents, there can be a leeway or approval given, or there is a policy in place by the bank for those executing those documents. But any kind of hypothecation agreement, any kind of sanction letters, your terms and conditions, your demand promissory notes, letter of continuities, all the list of executed documents should have the date before the date of disbursement. Existence of a system for implementation of IRAC norms. As I mentioned before, that there is again an update with respect to identification of NPAs and computation of provisions, an update which has been brought by RBI. So whatever updates are suggested by RBI in that circular, we need to ensure that currently sitting today, that system or that process is in existence. If not, then definitely that is a big red flag and that needs to be reported in your LFAR. Adequate control over changing of interest rates, terms and conditions in my core banking system environment. So whenever there is a change in the interest rate, say it's a floating rate, it's not a fixed rate, it's a floating rate of interest loan, or say there are certain terms and conditions which are tracked in the system. Whenever you are reviewing those loan documents for say a fresh disbursement or for any existing large advances, and if you see that the rate of interest of that particular loan is not fixed, it's floating, inquire with the bank as to how the core banking software has ensured that say a MCLR linked loan or any other benchmark that is used for linking my rate of interest, how that is linked in my core banking system to ensure that the entire process is automated and there is no manual intervention whereby the branch people are given authority to do so. Is there any question here? Yeah. So we'll skip this slide. So the slide was basically to present what are the fund-based facilities and what are non-fund-based facilities. But I think in our discussion till date, this is very clear. Multiple and sole consortium banking, I have already explained. Multiple banking is something, a loan which is sanctioned individually by different bankers to the same borrowers. In a sense, the bank is availing banking finance facility from different bankers. A consortium banking is such when a group of bankers come together to sanction one particular loan together, and there is a lead banker. So a project loan or maybe an infra loan which has a high requirement, and where multiple bankers are involved in funding those loans, the consortium banking kicks in. Consortium banking as a lead banker. Multiple banking, generally there is no lead banker. Everyone is independent in this case. Major areas of consideration. So what I was explaining earlier also, that once you go to the branch, before starting your audit, I think the first discussion for your advances should be to understand the entire life cycle of a loan, right from sourcing to my collections, NP identification, income recognition, and maybe restructuring, or maybe closure of the loan. So if a loan is foreclosed, or if it's a regular normal closure of the loan, we need to understand this. There are policies which are in place. There are documents available. You can ask for the entire credit policy, or maybe some kind of reading material which is available at the branch. But having this discussion will really help to understand the entire loan cycle which is adopted by your bank. Verification of the loan documents, as I rightly mentioned, that when you are looking into a large advances or my new disbursals, reviewing your credit approval note. When I say credit approval note, this will be a note including which includes or which contains the entire facts of the case. Who is the borrower? What is the history of the borrower? What is the financing history of the borrower? What is the financial health or the financial condition of the borrower? What is the loan requirement, or what is the loan request? Why it has been requested? What is the proposed end use? How bank ensures that what kind of credit evaluation they have done with respect to the loan amount that has been requested. Entire history, or say entire loan details will be available in the credit approval note. There will be someone who will be proposing for approval to some authority, and someone who will be approving this loan. Basis the loan approval note, you will have your sanction letters and other documents ready for before going ahead with the disbursement. Why reviewing these documents become important is that we need to check whether the bank has adopted a prudent and a correct methodology, in compliance with RBI guidelines, in compliance with their own process, whether the entire credit evaluation has been done prudently or not. You will find that in the credit approval note. And in the sanction letter, you will definitely find certain terms and conditions, where certain terms and conditions need to be satisfied before the disbursement. Certain terms and conditions will be an ongoing mechanism, and certain terms and conditions have to be satisfied after the disbursement of the loan. Having these documents in front of us, we can definitely go to the management, ask our specific observations, and ask them to give us the compliance with respect to the terms and conditions which are mentioned in the sanction letter. Because if any of those terms and conditions are not fulfilled and the disbursement has straight away happened, or say after the disbursement there are some post disbursement mechanisms which are not getting followed by the branch, and if you see this pattern in many of the loans, then yes, there is a significant control weakness that you have identified over here. External agency reports, where you will have legal report, valuer report, civil report, credit report, etc. So these all reports definitely form a part of the entire underwriting process, where bank is mandated to obtain valuation reports in term for the securities that are proposed to be mortgaged. Legal report to ensure that in terms of immovable properties, the title on that immovable property is clear or not. Civil report to to ensure that the loan that is being asked for or requested, there is no over leveraging that has been done. And in the entire credit evaluation or credit assessment, all my existing loan borrowings are getting considered. And if there are any signs of historical defaults by that particular borrower, that will get captured in the CIBIL report. And if you see that if you see the CIBIL report, if there is a series of historical defaults, or say a customer has been continuously paying the EMI with respect to the other banks with a delay of say 10 days, 20 days, 30 days, everything is captured in the CIBIL report. And if you come across this document, this kind of document in your file review, and still the bank has gone ahead with the disbursement, then yes, bank has to ensure that there are strong reasons available, reviewed and documented before the approving authority approves the loan. Acrylic report, like we rightly mentioned, for post disbursement part, to assess the repaying behavior of the bank, of the borrower. Internal inspection reports, like we mentioned, to see whether there are any fraud cases that are reported, which can become part of our file review. Post disbursement compliance, where I mentioned that perfection of security and registration charge in terms of my immovable properties are up to date or not. Maybe what we can ask over here is to give us the post disbursement tracker or post disbursement compliance tracker, where a list of cases will be available. Along with those cases, what are the post disbursement compliances that bank needs to track for those borrowers, and what is the current status as of 31st of March. And say if a loan has been disbursed in say last year or before that, there are certain post disbursement compliances that are to be followed and tracked, and those are still pending as at date. Then definitely we need to understand, why there is a huge delay, what was the reason, and if the answers are not genuine, or if the answers are not kind of satisfactory from the branches, then we need to assess if there is any significant control issue over here. So say if a mortgage registration has not taken place since last say 1 year or maybe 6 months or whatever it is, if that is still pending, then that particular pending activity definitely puts a bank at risk, because if that process is not corrected in say next few months or even before that, and if the borrower defaults, then the entire process of creating or kind of repossessing that security comes under question if the mortgage documents are not executed on time. So post disbursement compliance, yes, that is also one of the requirements that you can, or that is also one of the listings that you can look into during a branch visit. Detailed verification process, I will not discuss everything in detail, because we have been discussing everything. The first point, I think it has been well discussed before. Pre-audit work also we have discussed, where we need to review the closing circulars, significant accounting policies of the bank, what are the systems or the core banking software that are being used. Also, when you start your audit, when you take the list of advances, you will definitely kind of see what is the loan mix that is available at that particular branch. So is it a retail branch? Is it a retail branch that is focused only on housing loans? Is it a retail branch that is focused on two-wheeler loans or auto loans? Or is it a branch that is focused on personal loans? Or if there is a mix of these loans, getting a view of that before you start the audit, it will be really helpful for you to design your audit plan accordingly. SMA reports that we spoke about, the Acrylic reports. Sample selections for the file review. Top accounts on the basis of outstanding amounts as at the end of the quarter or as at 31st March 2021. At least few samples of each type of the facility covered should be selected for our file review. Sanction letter we spoke about in detail. Why reviewing the sanction letter is very important. loan documents as required by sanction letter. So again, this is what we have discussed. So there are certain terms and conditions, certain specific documents that have to be executed before disbursement, after disbursement. Everything will be mentioned in the sanction letter. It is important that bank ensures compliance with those documents. Now coming on the most important thing, that when we are reviewing the approval note, when we are reviewing the entire documentation with respect to the credit evaluation and say the behavior of the borrower, what level of checking we need to do to at least satisfy ourselves that this is a genuine case, this is a proper regulated borrower who has been repaying on time, and there are no specific issues as such. So once you review all the sanction letters, all the loan documents and everything, I mean the executed documents and everything, one of the most aspect of the verification of advance that kicks in is ledger scrutiny. So when I say ledger scrutiny, we need to extract the entire ledger from your core banking system for the given period. We need to see whether whether all the EMIs or the interest debits are kind of getting repaid on time. There is a proper churning that is happening into the account. So if it is a CC or a OD case, it should not happen that a borrower has taken a facility of say 100 crores. He has kind of pulled out that 100 crores and transferred to some other bank account, and there is no activity in the current account or the CC account, that is, so there is no utilization as such. Whenever interest is getting debited, the borrower maybe on the last day or on the second last day just comes and deposits the amount and pays it off. Or there can be a case where there is a continuous interest debit that is happening. The borrower is paying on the last day, and immediately on the next day there is some reversal entry which is happening. So the primary purpose of giving a CC or OD facility is to assist the bank, to assist the borrower in his working capital requirements, a WC or a OD facility that is given. So if that turnover is not happening when we do the ledger scrutiny, yes, that is something that needs to be questioned or that needs to be asked. Where there are frequent check returns, where there are excessive withdrawals. So if it is an OD facility, where there are excessive withdrawals in the account, where on a sample basis, if I see there are huge high value transactions which may not commensurate with the operation. So say if a MSME kind of borrower has availed a 50 crore facility, usually when such facilities avail for the working capital requirements, you will see transaction values ranging from a very small amount to a very higher amount, because that is how you utilize your CC facility for all your business led payments. But if I see significant high value transactions all the time, then definitely that needs to be questioned, because if it is going to some group company or if it is being utilized for some other purpose and not for the business purpose, then it is a red flag that there is something fishy that is happening. And if you are seeing any kind of such high value transactions, go to the branch management, go to the BM, DBM, whoever is there, give them a list of these transactions and tell them that you want to understand where these transactions are eventually ending up. They may forward it to the RMs, or they may speak to the client or whatsoever, and they may get the details and everything. Generally, when these transactions are happening through your net banking and everything, you may find some bit of these details in the narrations that are captured in the ledger. So if you come to know that this transaction is happening with some group companies, then yes, definitely it has to be discussed or highlighted. Or even if it is not with the group company, if it is within the same entity but with some different bank accounts, then you need to understand that eventually this entire facility is not being used for some other purpose. Whether in case of any defaults or any kind of underutilization of the facilities or otherwise, whether penal interest or penalty is being properly charged or not. So even you will come to know about it in the ledger scrutiny as well. So if the borrower is supposed to make some payment on some X due date, but he has done the payment on X+3, so there has to be a levy of penal interest for those 3 days, and you will find the clause of levy of the penal interest in the sanction letter. So once you review the sanction letter, you will find that yes, there is something called as penal interest for the default. If there is a default that you're noticing in the ledger, you can go back to them. Apart from ledger scrutiny, if it's a corporate client for you, you need to ensure that the bank has taken the financial statements, the recent audited financial statements of the borrowers. You should access to those financial statements, review the entire financial statements to at least understand that whatever history is getting captured in the loan approval note, is it matching with the actual details that are getting captured in the financial statements. So it can be a case where the company is into, it has been shown to you that company is into manufacturing of XYZ thing, but in the financial statements, you will find that there is the other income of that borrower will be higher as compared to the revenue from operations, indicating that the borrower has significant income source from significant other income source as compared to the main business itself. Now, if I'm sanctioning any loan, say any CCOD, or say if any kind of working capital loan, short-term loan, I need to ensure that where this is getting used eventually. If it is getting used for investing in the stock markets, or investing in the real estate, or maybe in terms of ICDs, or giving loan to some group companies, whereas the entire credit evaluation was done on the actual business of the borrower, then those two are very contradictory things. So to give you an example, I recently came across a case where the company was into manufacturing of aromas and perfumes, or what you call fragrance aroma or something. When I see the name, it is very much clear that the company was doing that. And when we spoke to the banking team about this, so they also mentioned that company is doing this business, company is doing fantastic, etc., etc. So when we actually started looking into the documents, when we started reviewing the balance sheet, we saw that the name of the company was this. Only 10 or 20% of the income was coming from their perfume business, whereas rest entire 80% was either interest income from some ICDs that they had given, or from some kind of fixed deposits that they had made. So then these two things did not correlate straight away. So then when we looked into the entire credit evaluation document, where they had plotted all their financial statements, where they had arrived at the profitability numbers, they had kind of seen what is the existing borrowing facilities, or loans that are already being taken. Then we came to know that this borrower is actually into fragrance manufacturing, but the entity that is taking the loan is into giving ICDs. So there was a strong disconnect in terms of what explanation is given to us, or what details are given in your Excel spreadsheets, and what is there in the actual approval, or credit approval note, or credit appraisal note, or whatever it is. So taking the financials is very important. Second, under CARO, we need to kind of report on the end use of the fund. So whether short-term funds are used for long-term purpose, or vice versa, or etc. If there is any such kind of qualification, or some kind of negative comments which are given by the auditors, maybe for some previous loans, there's a high chance that borrower might kind of use or utilize this loan for some other purpose. So if you're coming across any such qualifications, you need to immediately flag it off to the management. If there are any specific qualifications in the audit report, say if there is any EOM, or if there is any qualification on the assessment of the receivables, or maybe on recognition of income, or etc., whatever is the qualification, and if it straight has an impact on the income that is being assessed, or on the entire operations that are into consideration, then you have to go to the management and ask that if these are the qualifications, how have you ensured that these qualifications don't impact the credit assessment, and the end use of the loan is again done for some genuine reasons or genuine purposes. In case of a CCOD, there is a provision that the borrower has to submit stock statements regularly. Now, generally, when a monthly stock statement is submitted, it is always a management certified stock statement. Those numbers are provisional, those numbers are not audited, those numbers may be such that if there are any adjustment that needs to be done with respect to the physical stock and stock on record, those adjustments may not be done, etc., etc. As a bank, I would straight away, kind of accept that stock statement, compute the drawing power. Maybe if I have to allocate the drawing power to some other bankers, if there is a pari passu charge on my existing receivables, bank will note its own share, compare the outstanding balance, sanction amount, and the drawing power, whichever is lower, if that is getting complied, bank is okay with it. But there is also a process where if the stock statements are submitted and if the financial statements are available, so if a stock statement is submitted as at 31st of March and I have audited financial statements as at 31st of March at a later date, but I am able to access those documents during my review. And if I see a significant divergence or variance in those in the amounts that are considered for maybe inventory or receivable or payable or whatever, then that definitely has to be asked, because if there is a significant variance, which means that there could be a possibility where the borrower would have given you a higher numbers to ensure that the limits are not breached, or there might be certain adjustments which are not done on a monthly basis but are done on a yearly basis or something, but those are justifiable adjustments where borrower has given a satisfactory response, and even after seeing that variance, the borrower, the outstanding balance is still under the limit. But if this kind of variance, if you're coming across, and if this is the number which kind of can impact the drawing power for my previous periods as well, then yes, this is very important to be highlighted to the management, because there can be a high possibility where the borrower may not be disclosing the right numbers to the bank. For my immovable properties into the consideration, if I've created a charge on it, one thing that we definitely look into is the valuation report, whether a correct valuation has been obtained and whether the valuation that is kind of finalized and the sanction amount or outstanding amount, whichever I'm seeing, my exposure has been well covered with that valuation. But if I come across a valuation report where the valuer himself has given you a valuation, but he has given you a negative comment with respect to the property, with respect to the condition of the property, or maybe geographical measurements of the property, or title of the property, if he has come across anything, etc. And if those comments are not taken care of in the credit appraisal or something, that has to be discussed with the management, because ultimately, if there are any negative comment which puts banks' overall security into jeopardy, then it can be a process where if there is a repossession or something, that security itself may not be valid. Second, we need to review the bank's policy where the valuation reports, whatever number of valuation reports are mandated by the bank's policy, are getting. I mean, the branch is taking those requisite number of valuation reports or not. There is also provision where the bank's RM or whoever is the person who is the relationship manager of that particular borrower, he has to do a physical visit or a frequent visit to the business unit of the borrower, or he has to hold a proper discussion with the borrower on a timely basis, just to ensure that whatever numbers he is giving to us, maybe in form of a stock statement or maybe in form of some kind of disclosures, those numbers actually commensurate with the position in reality. So if he's telling you that there is a stock of say 100 crores, but when a RM visits and he does not see that particular thing, then definitely that is a red flag to you, and you should stress upon for the fact that you should ask for a physical visit report or a personal discussion report with the borrower by the bank. In case of a consortium loan, once a loan is kind of sanctioned by the consortium team, there is always a frequent meeting that happens at a periodical interval, if I say monthly or a quarterly, between all the lenders in that consortium group. So those minutes are always documented and submitted to all the bankers. So if you're having any advance under consortium arrangement, you should definitely ask for those consortium minutes, because generally in consortium, the borrower submits all the documents and everything to the lead banker. The lead banker reviews those documents. He takes the responsibility and he passes on whatever requisite details are to be given to the other bankers. So whenever a consortium meeting happens, the borrower is available, all the lenders are available. If there is any specific discussion that needs to take place on maybe on the repayment or financial health or any matter, everything is documented. So if you're looking at consortium arrangement, borrower, ask for the minutes. I'll also like to take few minutes to speak on the evergreening of the loans, which is very, very important in the current scenario, or where the loans are used completely for a different purpose than what it has been given over here. So say if you come across a case where you are having a CC or a OD facility that is given, the borrower is utilizing it on a regular basis, but you see that there is a temporary overdraft sanction that is given to the borrower. So what is temporary overdraft? So if I have a sanction of 100 rupees, my DP is say 120. So I can very well go and borrow 100 rupees from the bank. But there is a requirement where the borrower is asking, okay, give me 40 rupees extra on a temporary arrangement. And borrower seeing the actual requirement of a banker seeing the actual requirement of the borrower, he goes ahead and gives the extra 40 rupees and charges interest on it. But now, if there is a repetition happening in terms of asking of this temporary limit on a frequent basis, then it is quite a possibility that this temporary limit that he is asking for is not in compliance or is not being used for the business purpose. It is being used for some other purpose, because ideally when the bank sanctions a loan, it looks into account the projections as well as the current financial positions, or say your net working capital position of the borrower. And at the same time, if a borrower needs any enhancement for a long-term perspective, he'll definitely go and ask for an enhancement and not for a temporary limit. So there is something called as TOD report that can be generated from the system, which needs to be asked from the management. And if you find any particular borrower who has asked for a temporary overdraft or TOD on a very frequent basis, then yes, there can be a possibility where the loan is not being used for the correct purposes. Say a borrower has borrowed any kind of a limit from you. If it is a short-term loan, it has to be renewed after 1 year. And if it is a long-term loan, it has to be reviewed after 1 year. So say if a borrower is due for renewal or review, say as at 28th of February, or say as at the 30th of November, but there is a chance that the review has not taken place on time, and the banker has kind of extended the entire review or renewal process. But suddenly coming to your balance sheet date, or say nearing to the balance sheet date, the review has happened and everything is now in order and everything. Then again, there is a possibility that this can be a case of a red flag. Now, there can be a genuine reason why review or renewal has delayed. So maybe the client is not ready with the financials, or the documents or the requisite information are not available, or there is some genuine challenge at the end of the borrower to submit all the requirements that bank is asking for. But in any scenario, if you come across such case where there is a delayed review, but suddenly when there is a balance sheet closure and everything, the review happens, you should definitely ask from the bank as to what process was adopted, what level of documents were taken, and whether those documents of review or renewal justify the entire underwriting process or not. There is also NPA guideline with respect to a delayed renew or renewal, which will speak in the next slides. But if it is below the timeline which is given by the RBI for NPA for triggering of that NPA classification, but the review has happened very close to the balance sheet date, it is a red flag for you. Say when you come across any MSME kind of borrower who has availed the loan, if you look into their income tax returns or tax audit reports or whatever, and you see that the borrower is frequently dealing into the stock markets as well, and he has availed a working capital loan for working capital requirements and everything. We need to ensure, we need to check whether bank has ensured that those loans are not being used for investing in stock markets or not. So when you take the stock statement or etc., when you follow this procedure, you need to also inquire with the bank what level of checks they have taken place. Why? Because during the entire lockdown, where the businesses were not kind of scaling up, and where the limits were available with the bank, with the borrowers, there have been multiple instances where borrowers have used those unutilized limits for investing in the stock market, because it is a CC or it's a OD limit. I can withdraw that fund, park it in some other account, and I can kind of invest in the stock market. So at least when it is very apparent from some records that borrower has other source of income as well, what level of checks have taken place to ensure the correct end utilization of the loan. Yeah. Ketan bhai, any other instance where you can highlight on the evergreening of loan? Any example that comes across your mind?
So there are many examples, but what I was feeling that once you finish the advances portion, maybe whatever is remaining, I'll take it up.
Sure. Then next is on the asset classification. So interest or installment of a principal remains overdue for more than 90 days in respect of a term loan. More than 90 days, it is to be classified as NPA. Bill remains overdue for more than 90 days, it will be NPA. If cash credit or overdrafts remain out of order, which is described below, that outstanding balance remains continuously in excess of sanction limit or drawing power for 90 days. So sanction limit or drawing power, whichever is lower, if my outstanding balance is continuously in excess for 90 days, the borrower will be classified as NPA. Second instance, the outstanding balance is less than the sanction limit or drawing power, which is okay, but there are no credits for continuous period of 90 days, or the outstanding balance or the credits are not enough to cover the interest debited during the previous 90-day period. Now, there is a significant update that has come with respect to this, but it is to be noted that in CC limit, if there are no credits for continuous period of 90 days, or the credits are not enough to cover the interest debited during the previous 90 days, it has to be classified as NPA. If there are any irregularities with respect to the particular borrower, irregularities per se do not attract the downgrade, do not attract a borrower classification to be downgraded. Say a stock statement which is submitted for calculation of DP is more than 3 months old, is less than 3 months old, and he submits the stock statement immediately after 3 months, we are okay with it. But say the borrower has not submitted the stock statement for more than 3 months, and the bank is continuously using that stock statement for a continuous period of next 3 months, then the borrower will be classified as a NPA. So for 3 months, I am okay if he submits the stock statement. Say immediately for the previous 3 months, he has not submitted the stock statement, and I'm using the older three, say the stock statement of say 3 months old or even more than that for calculating my drawing power, then the borrower will be classified as a NPA. Or the account where regular or ad hoc credit limits have not been reviewed or renewed within 180 days from the due date of actual renewal or reviewal, or the due date of ad hoc sanction, then this will be treated as an NPA. So what we were discussing in the last slide precisely is that if there is no renewal, reviewal, or whatever process that has to be adopted, if that is not happening within 180 days, the threshold which is given by RBI, then on the 181st day, the borrower will be classified as an NPA over here. NPA class, I mean, the period or the criteria for substandard, doubtful, and loss assets are pretty much the same. They have not changed over the years. Advances against term deposits or NSEs, KVPs, IVPs will not be treated as NPA provided adequate margins are available, which means that your exposure has been adequately secured or covered against these liquid securities. Note that advances against gold, ornaments, and government securities and all other securities will not be covered in the above mentioned exception. So when a security in term of in form of term deposit, NSE, KVP, or IVP, and life policy, insurance policy, if that is available, then only NPA classification may not be done. But say even if you are adequately covered under your gold security, gold ornaments, or government security, but if you have not met the repayment criteria for 90 days, which we spoke about in the last slide, then it has to be downgraded.
So Jay, what is your view about ULIP policies in LIC?
We can still consider ULIP policies, but again, those are all my linked policies. So if the security value is, if we can see very much clearly that the security value is kind of not adequate to cover my exposure, then those have to be downgraded, because ultimately it is nothing but a loan against security only, in my view.
So Jay, see, look, the difference is the loan against NSC, KVP, and IVP are exempt from NPA norms. And so as you know, the LIC policy, the RBI has not clarified what LIC policy is, but predominantly the view is the traditional plan where government was giving a guarantee, like sovereign guarantee was there on traditional plan, which were issued by Life Insurance Corporation of India. But fortunately, unfortunately, you know, they have not clarified about the other companies, private companies. But the view taken is that the those advances are not exempt from NPA norms. The other advances like advance against NSC and KVP and IVP are exempt. But if there is an advance against ULIP policy, you will have to apply the NPA norms.
NPA norms. And so I am asking you one question over here. Is say if it is a non-LIC policy, will we still go ahead and take this benefit of exemption, or we can? It has to be governed by the extant IRAC norms.
No, that's what I'm saying. Except traditional plan of LIC where there is a sovereign guarantee, in any other case, we will apply NPA norms.
Okay. So next is on the provisioning norms. Again, the percentages that we are seeing here with respect to the provisioning requirements, those have not undergone any change in the recent RBI circulars. Those remain the same. But yes, as a auditor, we have to ensure that whatever provision calculations are done at the branches with respect to the NPA accounts or NPA cases, the calculation meets the requirement of the RBI guidelines, which we have summarized over here. Only I think in case of restructured advances, generally the provision is 5%, but higher provision will be attracted if we have restructured, if the bank has restructured the loan under COVID-19 resolution framework. income recognition, as auditor, we should ensure that the bank has not booked any interest income on NPA cases. Those interests are specifically reversed once the account is classified as an NPA. But again, how Ketan bhai mentioned, interest on advances against term deposits, NSCs, IVPs and KVPs and life policies may be taken into income on the due date, provided adequate margins are available. But it is very important to know that bank has got all these underlying documents available with them. Those are not fraudulent documents and those are genuine documents. So if any kind of loans, such loans still exist in your branches, it will be prudent for you to take a couple of samples and check the underlying security, because all maybe term deposit is still okay, because these term deposits will be ideally with the same bank, and bank will just create a lien on it. But NSCs, IVPs, KVPs, all are aged old documents which are currently not seen as an investment instrument. So whether those documents are available or not, have been properly safeguarded or not, that we can definitely check here. If the government guaranteed advances become an NPA, interest on such advances should not be taken into income recognition or income account unless the interest has been realized. Again, so government securities over here is something, government securities, a state government or a central government security over here. RBI has clearly mentioned that those will not be exempted from the RBI or from the NPA classification. But yes, for the life policies, how Ketan bhai mentioned, that is perhaps the logic behind considering life policies may not be exactly, correct.
So Jay, in case of government guaranteed advances, these central government guaranteed advances are exempt from NPA. It is guarantee available and it's not, repudiated by the government. For the state government account, you have to apply the normal NPA.
Yeah, correct. I made a mistake there. Yes. Then next is verify the interest calculation are correct or not, sample basis, and check the system calculations also or not. So whenever you are taking any sample for file review, when you are doing a ledger scrutiny, at least do a recalculation of the interest that is being levied with respect to these accounts, whether the rate of interest that is mentioned in the sanction letter has been correctly captured in your core banking, and whether the logic of calculating the interest, say it is a 31 by 365 or 30 by 360 days, whether daily interest is getting computed by the system or not, compounding is happening or not, whatever is the policy eventually taken by the bank, whether that particular policy is getting complied for all the borrowers or not. So it should not happen that in one case we are taking 31 by 365, whereas in other case we are taking 30 by 360. So the logic of the system should be consistent across all the cases. If any advance, including government guarantees, bills purchased and discounted, become NPA at the close of any year, interest accrued and credited to the income account in the past periods as well should be reversed or provided for if the same is not realized. So, say your 90-day compliance falls between a 2 financial year period. So, say 90-day is triggered after 31st of March. If that is the case, then whatever interest was recognized before 31st of March plus whatever interest is recognized after 31st of March, cumulatively will have to be reversed on the day account becomes an NPA. I think the most important factor that we are currently looking into is the recent updates. So one is that till 30th of September 2021, there was no prudential norm circular on income recognition and asset classification issued since 2015. So from 2015 till 30th September, we were using the 2015 circular as a reference. But on 1st October 2021, RBI came up with a revised master directions, which incorporated all the recent COVID-related amendments as well. On 1st October 2021, when this circular was issued, there were certain ambiguities with respect to the language or with respect to the intent, maybe. And for that, RBI came up with a clarification on 12th November 2021 and 15th November 2022. Both we'll be discussing in the immediate next slide. Other important circular that we need to kind of look into is the Resolution Framework 1.0 for COVID-19 related stress on 6th of August. I think that was already covered in the last year's discussion perhaps. Similar resolution frameworks were announced for my MSME advances as well on 6th of October 2020. After the second wave, RBI came up with the extension of the same circulars dated 5th May 2021 through the COVID Framework Resolution 2.0. Other important updates that we're looking into is the automation of the NPA classification, NPA identification, asset classification, and provisioning calculation, which was communicated by RBI to all the banks on 14 September, but which is effective from this current financial year. I think we spoke about the LFAR update, which was done on 5th of September 2020, and there is another important master direction on priority sector lending, which generally is which perhaps is kind of followed at a regional or a head office level. But if you're having any priority sector compliances to be checked at your branch level specifically, this master direction becomes important. So the recent updates on or the master directions on 1st of October 2021 vis-a-vis the 15 or the 2015 circular, I'll only speak on the two key updates over here. One is that with respect to the partial write-off and technical write-offs. So earlier also, say a loan is kind of written off in the books, say a part amount is written off and part loan is still existing in the books. Or if there is a, if a write-off has been done basis some with some discussions or decisions by the management, it was observed that in many cases, once a loan is partially written off, the remaining portion of the loan was still was classified as a standard asset. But generally, when a loan is written off, those loans are already an NPA advance. And if a part loan is written off, it is very logical that the remaining portion of the loan which is still in the books, it has to continue as an NPA. And that was a clarification which RBI brought up in this circular, and they brought up with a specific disclosure requirement with respect to the technical write-offs. Second is on the creation or on the implementation of the resolution plan. So whenever a resolution plan has been implemented with respect to mainly with respect to the large borrowers, additional creation was supposed to be, or additional provision is supposed to be created for those particular borrowers. But there is ambiguity on what will form the basis for what will form the amount on which you will apply the provisioning percentages. So RBI has now come up with a clarification that for all the cases of resolution plans where you are creating a provision, the provision will be created on total outstanding balance, which includes both fund-based and non-fund-based exposure. Earlier, since the clarity was not that visible in the circular, some banks used to opt only for the fund-based exposure. Second is the updates on 12th of November and 15th of November. So it is applicable to all the banks, including NBFCs, even though we are not touching NBFCs in the current discussion. What is the background of this update? RBI on 1st October brought the IRAC norms. With a view to ensure uniformity in the IRAC norms, certain aspects are being clarified via these two circulars. One is disclosure of specific due dates and repayment dates. So earlier, maybe across the practice which RBI saw or whatever was communicated through them through different modes, I think there was some ambiguity with respect to the due dates that were printed in the sanction letter. So the due dates were not very clear. So maybe it spoke on 30th of every month or 5th of every month, or the repayment will be quarterly, or there will be a bullet repayment. That's it. There were no specific dates that were given. So through this circular, RBI has come up with a specific requirement that all the sanction letters and loan agreements will specify exact due dates of repayment of loan, frequency of repayment, breakup between principal and interest, which is your repayment schedule. So if I am only mentioning EMI of 100 rupees, that will not be acceptable. You have to give a proper repayment schedule for that particular loan, along with a split between the principal and interest. an exact date of commencement of repayments in case of moratorium loans, or in case the borrower is opting for a moratorium. The borrower shall be appraised of the same at the time of loan sanction, so that there is a very clear communication, and also at the time of subsequent changes, if any, to the sanction letter or the loan agreement, the same shall be clearly communicated. What is the due date for this? So for the fresh loans, that is new disbursements, any loan which is disbursed after 31st of December, you have to comply with this in your sanction letter or loan agreements. For the existing loans, this has to be complied at the time of annual review or renewal. So whenever you are doing the annual renewal, you will issue a fresh sanction letter. So at that time, these conditions are to be taken care of. Next is classification of loan as SMA and NPA. So the table below gives the cutoffs with respect to how a loan will be classified as a SMA 0, 1, 2 in case of my non-revolving facilities, and SMA 1 and 2 in case of revolving facilities, which is your predominantly your CCOD or your WCDLs. So earlier, what used to happen, again, there is a different practice which was getting followed, and hence this clarification came across. So say if the due date is say 30th of April 2021 to pay any EMI, many banks used to start their default reporting from 1st May 2021, stating that the borrower, stating that the day one of default is 1st of May 2021 or 1st of May. But RBI has specifically come up with this particular clarification that any classification of SMA or NPA shall be the calendar date for which the day-end process is being run. So if a loan is due on 30th of April 2021, and if the borrower has not paid the due date, he has defaulted on 30th of April and not on 1st of May. And hence, all your SMA reporting and your NPA identification will shift by T-1 date. We'll see an example in the next slide. Second, flagging of the overdue status has to be done on a daily basis. Earlier, I think there was a varied practice which RBI would have seen, that the reporting of NPA was done at maybe at a monthly level, at the end of the month and not during the month. So say if a borrower has defaulted during the month, but just before the end of the month he has repaid everything, the borrower was not classified under SMA 012, or if he has say defaulted for all the 89 days, he was not classified as NPA if he has repaid everything on the 90th day before the end of the quarter. RBI has categorically told that all your NPA identification will happen on a daily basis. Your SMA tagging or classification will happen on a daily basis. And if the systems were not in place to comply with this, all the banks were kind of directed to ensure the compliance immediately with no benefit or leeway given for this. Again, only thing is instruction on SMA classification of borrower account shall be applicable to all loans, including retail loan, irrespective of the size or exposure of the lending institution, except for agricultural advances. Now we are seeing an example over here. Earlier, whatever you're seeing in the first line, colored in green, that was maybe a previous practice or a varied practice followed by all the banks. So say if a overdue status was on, the due date was on 31st of March, say 2021, the bank could report overdue on 1st of April, and SMA 0 would also be triggered on 1st of April because it is from 1st day to 30th day. And say if the borrower has not paid any loan for continuous 90 days, the NPA was the borrower was classified as NPA on 30th of June. But with the current clarification coming in, if the due date is on 31st of March, the overdue has happened on 31st of March at the end of the day when the collection batch is being run. So whenever, say if there are any check payments or NACH payments or RTGS or any FT or whatever, if the borrower has made that repayment, I think there is a process in the bank where you run the collection batches at a periodic interval. So whenever you're running the last collection batch, and if you're still not getting that particular EMI collected from the borrower, on the due date itself, you will classify this loan as overdue, SMA 012. And hence, if you see here, the NPA will now happen on 29th of June, when it triggers the completion of 90 days. So on the 91st day, which is 29th of June, your account will be tagged as an NPA. I think this is the most important clarification which is coming in. And as a branch auditor, although this circular is applicable to all the banks, so your central statutory auditors would have definitely taken care of this at an overall level. But as an auditor, branch auditor, you also need to make an inquiry with the management, check their systems if that is a wise way to do it, and ensure that this particular compliance is being taken care at the branch level itself. If you get an answer that this is being complied at a HO level or something, please pass this point as a discussion with your central statutory auditors and make a note of it in the LFAR. And if there are any significant NPAs that you are seeing in your current portfolio, then this can be a trigger point for, say, if a due date is on at the end of the month and the borrower is paying, say, after 1 day or something. One important criteria is date of payment shall be the actual collection of repayment by the bank and not the date of the submission of the payment instrument. So if I'm giving a check today on the due date, it cannot be construed as telling that I have made the payment. The day when the actual collection happens in the, or it is reflected in the repayment schedule of the bank, that is the date of actual payment. Second important is, I'll take the second point first, upgradation of accounts classified as NPAs. So now what practice was currently being followed maybe by many branches or banks is that if a loan has already gone into an NPA, he's done into 90 days, and say if he has paid 90 days predominantly will mean he has defaulted on 3 EMIs if it is a monthly repayment borrower. And if he has paid 1 EMI or 2 EMI, say the next month's EMI which is due and the one outstanding EMI, the borrower will fall back into a sub 90 DPD category. So that the delinquency or the default dates will come before 90 days or less than 90 days. And hence the account was immediately upgraded because now he has not defaulted for 90 days, continuous 90 days. And hence the borrower's account can be upgraded. But RBI has clearly mentioned that this was already mentioned in all the master circulars before, but since it was being interpreted differently by different banks, RBI has clarified that an account can be upgraded as a standard asset only if the entire arrears of the interest and principal are paid by the borrower. So if 100% payment is done, then only an account can be classified as a standard asset. So even if it is from 90, it comes to a 60 days or a 30 days or whatever, the account will still remain under NPA category. And hence your provisioning calculations will also undergo a change in this aspect, because earlier if it was a 60-day, a lower provisioning category or percentages will attract. But once an NPA, the provisioning category will, or the provisioning percentage will be the same till the time your default position is not back to zero. So whenever you are checking on the asset classification, and if you are seeing any upgrades, specifically if the bank is telling that you have upgraded a loan, but if the upgrade is not with respect to a default day being triggered back to zero, this will be the particular update that you need to take care of.
So Jay, I'll just add you over here.
Yeah.
So basically what was happening, when you have, 4 or 5 accounts of a single borrower, one account is NPA and the dues are not paid. And accordingly, the other accounts are made NPA. Now, what borrower used to do is he used to repay only in one account, and the irregularities in other account, though they may be less than 90 days at that point of time when they became technically NPA, they used to leave them. Only one account they used to repay, and moment that account is standard, they used to say कि बाकी का तो technical NPA था तो उसको भी standard कर दो, and there were outstanding up till 89 days overall in all those accounts. So to curb this, practice, the Reserve Bank of India has given this clarification. Otherwise, this was there earlier also in 2015 circular and now also. But they wanted to, specifically tell the auditors that, look, whatever irregularities are there in other account also, those who became NPA technically because of the other account, there also all irregularity needs to be cleared. So you will have to be carefully look at the other account. one account which became NPA and the other account which technically became NPA, there also only and only upgradation if the irregularities are zero. Yes, Jay, please continue.
Correct. So I think you have rightly mentioned, even the NPA classification, not at a single facility level, but at a borrower level, that was already mentioned in previous circulars, but that may or may not was that was not getting complied fully, and hence what Ketan bhai rightly mentioned, even if one facility is getting into a NPA classification, all other facilities, even if it is a standard into a standard category, will be tagged as NPA, and upgradation for all the facilities together will happen only when your total delinquency in all the facilities come back to zero. Next is on the interest classification in case of interest payment. So in case of interest payment with respect to interest loans, term loans, an account will be classified as NPA if the interest applied at specific rests remain overdue for more than 90 days. So here also, I think there was the language in the master circular was, I think, perhaps not very clear, and hence RBI has clearly said that if the interest payment remains overdue for more than 90 days, then on the 91st day, that particular borrower availing the term loan will be classified as an NPA. Yeah, I think this particular clause is one of the most debatable, kind of clarification that has been issued by RBI. So when in case of a CC or OD facility, when we spoke that the credits are not enough to cover the interest debited during the previous 90 days. Now, what does this previous 90 day mean? This is something which is which needs to be discussed. The previous 90 days period for determining an out of order status shall be inclusive of the day on which the day-end process is being run. And the definition of out of order as clarified by the circular shall be applicable to all the loans where interest payments or repayments are only credits, where in CCOD it is typically the interest repayments that are still happening, or that is a principal repayment criteria. But what is this previous 90 days? Now we'll go through the example over here where what was the practice that was currently being followed by different practices by different bankers. One, if you see, is that on 31st Jan, 20th February and 31st of March, 100 rupees each was getting debited as interest on the 3 months. So 100 was for Jan, next 100 was for Feb, and next 100 for the month of March. Now, in that particular quarter, if my total credits are only 200, which is not enough to cover my entire 300 worth of interest debit, then there is a shortfall, and hence the account is classified as NPA on 31st of March itself. That was one practice being followed where the asset classification of a CCOD was being viewed at a quarterly level. But if I see the second practice which was being followed by different banks, when there is a interest debit of 100, they see that this 300 worth of debit is for the quarter ending 31st March 2021, and hence a borrower is required to repay this 300 rupees of interest in the next 90 days till 30th of June. So now if I see there is a 100 rupees inflow on 31st of March and 200 rupees inflow on 30th of June, and this 300 in the next quarter is sufficient to cover the interest debits in the previous quarter, and hence the account was still classified as being standard. This is a practice which is being followed by many banks till now, and hence there was no consistency in the practice that needs to be followed for the CC and OD NPA identification. Now, when RBI came up with a guideline telling that you need to see a previous 90-day category for any interest or for any collection. Now, if you see here on the first table on your left, you will see that there is an interest debit of 100 on 31st of October, on 30th of November, and on 31st of December. Now, if I see on 31st of December, my previous 90 days are 3rd of October. And on 30th of November, if I come, my previous 90 days is 2nd of November. Now, on 30th of, if I have to test the DPD position of this particular borrower on 30th of January, sorry, on 30th of January, then I have to see what was the collection from 2nd of November till 30th of January, and whether it was sufficient to see whatever was interest debited in that 90 days bucket. So from 2nd of November till 30th of January, 200 was the interest that was debited and 150 was the interest that was getting collected. Now, if I see here, there is a clear shortfall of 50 rupees on 30th of November, and hence this account has to be classified as an NPA. Now, if I see on the immediate next day, if on 31st of January, if the borrower paid me 200 rupees, and on 31st of January, there is another interest debit of 100 rupees. And if I see on 30th of January, the previous 90 days is 3rd of November 2021. Now, if I compare my total debits and total credits over here, okay, I think in our case, say assume that my total collection was 300 rupees on 31st of January, and hence my total collection between 3rd of November and 31st of January is a 350 rupees, and my interest debit in that period is 300 rupees. Hence, my collection is more, and hence the account is now a standard account as at 31st of January. Now, this particular provision is a fact that on 30th of November, if account is tagged as an NPA, all other facilities are also tagged as an NPA. Now, when a borrower is clearing his overdues in all the accounts to come to a zero level, which we spoke in the last slide, then only an account will be classified as a standard asset. Now, assuming that this is an example for one single account, where technically now a borrower is in a standard category for this particular account or this particular facility. But in any other facility, if he has defaulted and if he has not kind of rectified that error or rectified that default, the borrower will still be classified as an NPA. So merely because of 1 day difference, I can see a difference in the NPA classification. So this previous 90-day category, whenever I'm going to see it, I at least have to ensure that banks are using the previous 90-day logic over here. A second practice that is getting followed here is that, again, for this previous 90-day, if 100 rupees is being debited on, say, 1st of January, I will go and see what are the collections in my next 90 days. And if on the 90th day, in the upcoming 90th day, if there are no collections happening, then the account will be tagged as an NPA. It is slightly kind of confusing as to what has to be followed. So if your bank is following practice 1, or if your bank is following practice 2, first get a clarity on that. If a bank is following your is not taking next 90 days, but it is taking the 90 days before that, and if he's calculating the debits and credits to that aspect, then you need to ensure that your practice number 1, the table that is getting satisfied properly. But if the bank is following the next 90 days as a criteria, and on going on 91st day is telling that there are no credits on previous 90 day, if that practice is being followed, then we need to ensure that your 90-day calculation is getting correctly computed in the system or not. Ketan bhai, if there are any inputs.
Yeah, so 2-3 points when this clarification came, like a lot of debate, discussion, as rightly told by Jay, were happening, and some discussion happened with the Reserve Bank of India official also. So whatever oral clarification which I understood from some other speaker, point number 1, what RBI was saying, there was one circular in this year which came in, wherein RBI said that if one party is having current account and CC account, they need to close current account. So that was one development. Now let's say if that there is no current account, I have only CC account, and some new loan is getting disbursed. So let's say he is taking some fresh loan, short-term loan, some loan against LC or whatever. So what was happening? Those amounts were credited to the CC account. So RBI said that. So RBI said, look, if those amounts are credited to the CC account, computer is GIGO. So what computer does is it takes those credit as the credit towards loan. So RBI said now you will have to look at the quality of the credit. If there is a fresh loan which is being credited to such CC account, should not be counted for the credit purpose. That is one very important point which emerged out of this discussion. Second, coming to these dates. Now, why this is needed and why it is creating a confusion. See, basically, we have been, the banks have been doing that, either they have been doing classification on a monthly basis, on a quarterly basis. Earlier, RBI said that do it on a quarterly basis. Then they said on monthly basis. Then they say it now on a daily basis. So at any given point of time, I will look at that, whether there's a past due of 90 days, there's a DPD of 90 days or not. And looking at, sufficient debit and credit, irrespective of whatever has happened, you may comment upon the system, whether it is rightly done, wrongly done. But to my mind, as of 31st March, you as a branch auditor will go and look at 31st March. I'll look at that, whatever is outstanding, what is a debit throughout in that account in, a year, what are the credit. Let's say in between 5 times it became NPA, but at the year end it is standard. Then it is standard. And there is a, clarification in RBI circular of, irregularities being, cleared at the year end. So I'll go at year end, I'll look at that, whatever interest is debited or whatever debits are there, are they sufficient to, covered by those quality credit or not? If they are not covered, and if there is an outstanding, then definitely more than 90 days outstanding remaining in that account will be NPA. So calculation is bit tricky because of this, day end process pay, ye jo karna hai, day end process pay, they have to apply the NPA norms. So there's a possibility that one account might have become, 5 times NPA in a year, and at year end it is standard account. So you will have to apply those NPA norm at the year end, apply your mind on that. And if there is a lacuna in the system, if that one day calculation is not corrected, as rightly told by Jay, most of the banks have, corrected their system in second or third quarter. So I don't think you will get those errors now. But still, you, as an auditor, it is your duty to check that, exact 90 days calculation is being done. या वो एक दिन का लफड़ा अभी भी चल रहा है. एक दिन जो in his example he said on 30th June or on 29th June. That's the exact example which is given in the circular. So if that 29 June ko, if that is not becoming NPA, then there is a serious problem. Then, as he rightly said, immediately you will have to write a mail to the head office, to the central auditors, stating that the system is not working. But let's say that system is working fine. Then you come at year end and see the, the amounts debited, amount credited in a CC account, and only quality. He rightly gave an example of share transaction and all other transactions which are non-business transactions. So if there are non-business transactions, you will have to, exclude there, or you'll have to apply your mind and, knock off those debit credit, and then, look at the quality of the credit. So your job has become more difficult and little more tricky because of these clarifications. But irrespective of that, a FIFO application, what we can understand from these examples is that RBI want, those knocking off of debit credit on a FIFO basis. So I can say that, whatever debits are there, I'll knock off them, against my, the credit I will knock off against the, on a FIFO basis to the debit. And if there is anything remaining, and that remaining amount is outstanding for more than 90 days or completing 90 days on 31st March, the account needs to be taxed as substandard. So as he said, there can be, different views on this, but this is the view normally prevalent, and, almost all the speakers have been taking on this subject. Jay, you can proceed, or if any question is there, we can answer that.
Correct. So as you rightly mentioned on the quality of credits, because say if there are any credits that are coming into the account, just to comply with this 90-day criteria, and immediately the next day if they are getting reversed, if you see the similar trend in, say, in last 1 year, then yes, those credits are not quality credits, as Ketan bhai rightly mentioned. Second is that if I stand at 31st of December, at least 31st of March, I'll at least go and see for last 90 days whether the credits and debits are correctly matching, and if not, then on 31st of March at least these accounts has to be classified as an NPA. Third thing which can definitely come into my mind is to test this daily NPA tagging, is that take random 10-15 days during the calendar and ask the bank to provide you a NPA classification report from the system. If that report is correctly getting generated, if they are giving it to you, and say for sample 4 or 5 cases you are, I mean, if there is genuinely any DPD, or say if there is any default days that are getting captured, you can take 4 or 5 sample borrowers, go to their system and check whether that calculation is, DPD calculation is being properly done or not. If that is the case, then yes, at least on the daily NPA tagging or NPA or a daily default tagging, SMA tagging, you are covered off for 90 days.
So Jay, only correction is, instead of taking NPA statement, you calls for the days of default.
Default statement. Yes. And then you need to,
Yeah, sorry. Because वो क्या है 89 days पे होता होगा तो वो NPA में दिखेगा ही नहीं. And it will come in, this overdue statement. So you tell them that, I need a overdue statement.
Overdue statement, default statement or overdue statement, not NPA statement. And whatever practice is being followed with respect to the application of credits to your debits or to your interest, whatever process is being followed, if you agree with it and if it is in compliance with this circular, yes, we are good to go. Members, if there are any queries over here, feel free to ask, because I think this is one of the most crucial discussion point here. All right, if there is anything, you can always reach out to us. We'll move to the next updates. On consumer awareness, it is mainly on displaying consumer awareness related literature on their websites, and with respect to overdue NPA classification.
Yeah, you can skip this.
I can skip this. Yeah. Next is on the COVID resolution framework. Only update that we need to see here is that all the loans that were under COVID resolution in framework in the previous period, whether the asset classification is being properly done or not. So in case of personal loans, asset classification norms will be same as your IRAC categories, which we spoke about for 90 days. For other loans where we have taken a resolution plan where any borrower has signed a ICA, and if there is a default in that case during the implementation period, then it shall review a trigger period of 30 days. The loan will be, the borrower's performance will be monitored during this review period. And if the default is not rectified till the 30th day, on the 31st day itself, the loan will be classified as an NPA. But on what date? So here the loan will be classified on the day when the resolution plan was implemented. We'll come to an example over here. Second is that if a borrower is in default with any of the signatories to the intercreditor agreement at the end of the review period, the asset classification of the borrower with all the lending institutions, including those who did not sign the NCA, shall be downgraded to NPA from the date of implementation of the resolution plan, or from the date from which the borrower had classified as NPA before the implementation of the plan, whichever is earlier. So again, this is very important, where you have to take a list of cases where non-personal loan cases where a restructuring framework was implemented, a resolution plan was implemented, and you need to test this criteria with respect to review period, measuring or making good during the review period, and if not, then what is the actual asset classification. Say, for example, in case of a personal loan, the date of implementation of restructuring is 1st of September 2021. If he has taken a moratorium and if it ends on 1st October, and if he has not paid any loan after that or any EMI after that, and on 31st Jan 2022, the DPD position, the delinquency position is 90 days. So NPA will be directly on 1st February 2022. On other loans, if the date of implementation of the resolution plan is 1st September 2020, the moratorium period ends on 31st of March 2022 as per the terms and conditions. If there is a DPD on 31st December 2021, then there are 30 days available or a review period available where the borrower has to bring its DPD back to zero. If that is not happening, then on the 31st day itself, sorry, I think it's not 1st September, it's on 31st January itself, the loan will be on 31st January, if there is 31 days, and if that is not getting, if that is not getting rectified, then the NPA will be on the day when the resolution plan or the restructuring framework was implemented on 1st of September 2020. So you have to go back and put the NPA classification date on 2020, and then check whether the substandard category or doubtful category or whatever is the case, whether that is getting followed over here or not. Because if the implementation date is more than 12 months, then the loan will not be classified as substandard. It will directly go into a DA1 category. So this is how this restructuring framework loans sanctioned under the restructuring framework will work. For Resolution Framework 2.0 dated 5th of May, I think it is very clear where the exposure is not more than 50 crores. It should be a standard asset on 31st March 2021. Last day of invocation is 30th September. Implementation date is 90 days from the invocation date. And here it is important that provision for these cases will be higher of the actual IRAC norm provision or 10% of the residual debt, whichever is higher. So we need to at least ensure that provision computation in respect of cases where COVID framework 2.0 has been triggered, this has been done correctly or not. For my MSME loans, so those are personal loans, and other than personal loans, for MSME loans, we have a specific framework available. So 1.0, it was on 6th of August 2020, which is done in the last year. So we'll touch on Resolution Framework 2.0 on 5th of May 2021. The exposure is 50 crores. Until 3rd June, it was 25 crores. They've updated that. Asset classification should be standard till 31st of March. Last date is 30th September. Implementation date is 90 days. And provision is 10% of residual debt. So here, you need not see what is the actual IRAC norms and see with whatever is higher. Here, straight away, you have to create a provision of 10% on the residual debt. NPA identification automation. We'll quickly run through this. On 14th of September, the circular was came, and all the banks are mandated to put a automated software-driven NPA identification by 30th of June 2021. So at least during the coverage period, you need to ensure that all your NPA reports are driven or taken out from the system. There is no Excel calculation or manual intervention available in that. All your asset classification. So once your loan is identified as NPA till 12 months, it is a substandard. More than 12 months, it is DA1, DA2, DA3, whichever category is given. Whether a loan is a loss asset because of erosion of your valuation, net worth, whatever other loss asset criteria by the bank. Every logic has to be built into the system, and there has to be no manual intervention whatsoever with respect to your income recognition, asset classification, and provisioning also. So your provision numbers should also come from the system. You as an auditor should recompute the provision either for totality or on sample basis and ensure that these are getting covered or ensure that the logic is being implemented correctly. Again, this should be taken care at the HO by the central statutory auditors, but you as auditor have to ensure that all the reports are system generated. If not, and if you're not getting a satisfactory answer, please reach out to your central statutory auditors or your HO team to highlight this issue straightforward.
So to add here, see what happened in Punjab Maharashtra Cooperative Bank. If you would have seen or studied that failure of that bank, the auditors were given Excel sheets, and auditors were relying on Excel sheets, and all Excel sheets were manipulated. And this automated system point is there since ages in the RBI circulars, but banks were not implementing. RBI was taking it very, very casually. के चलता है, inspection में वो देखते थे. Even United Bank of India, when special audit was carried out by one of the big four, they said that the automated system was available, but it was switched off and the manipulations were done. So now RBI is very, very serious about it, and it's putting that on the auditors that you check whether automated system is running or not running, and whether the accounts are classified by automated system, and you are getting a report from straight away from system, and not, as he rightly said, not on those Excels. Because in case of Punjab Maharashtra, all the Excels were manipulated, and the names were changed of the borrowers, the data was manipulated and then given to the auditors, and auditors were held and they were behind the bar for a long time. And in fact, the DC proceeding is also going on both against the interim auditor, against the statutory auditors. So, these type of cases have happened. That is why we must see as an auditor that this automated system is running and the NPAs are classified only by way of automated system. Jay, please continue.
Yes. Thank you, Ketan bhai. You can refer back to the circular where the exceptions are given, but exceptions are again minimum and temporary in nature, and all the exceptions have to be authorized by a competent authority, where in this case should be as per the board approved policy by CEO in case of the unavailability of the board. There are certain divergence, or we can see a thematic reasons why certain divergence were identified by the RBI with respect to the loans of
Jay, we need to close in next 5 minutes. That's the
Yeah.
message from the organizer.
This is the last one, and the rest is on the LFAR. So LFAR, whatever changes are
skip
there,
it.
we have highlighted that. So
Yeah, we'll circulate this presentation with your permission. If you permit, the organizers will circulate this
Yes, yes,
PPT.
yes.
So maybe we can take this up, and if there are any question or 1 or 2 points which I want to add, I'll add, and then we can close it.
Yes, yes, yes. So these are the reason for divergences, which I think you can look into when the presentation is circulated. Please, kind of go through these listings to ensure that these are not the cases in your branches. And if these are the cases, then this has to be immediately kind of caught upon and discussed with the management. I think in the LFAR, I have highlighted the cases or the questions which have undergone a change from the previous reportings. Nothing over here. One important thing is we need to do a verification of the cash at the ATM as well, and not only at the vault. Earlier also we were doing it, but we have to report on the non-compliance and the differences. With respect to money and call at short notice, generally it is managed by HO, but if it is to be done, your opt-in balance confirmation, and please do a yield analysis to ensure the correct interest accrual calculation. With respect to deposits, it's mainly on the FCNR deposits, whether the scheme of automatic renewal is being applied. Again, you need to check on the non-resident status and ensure that it is in compliance with the RBI guidelines.
So the problem out here is, again, as he rightly said, auto renewal ho raha hai. That person has become resident from non-resident. फिर भी auto renewal चल रहा है. So such cases are found and by Reserve Bank of India under their inspections. So we need to be careful. If there is an auto renewal happening, are they ensuring that person is NRI or not? That is very, very important.
Right. Next is on the branch complying with the minimum balance requirement. There is a circular on 1st July 2015. You can refer that circular. It primarily speaks on the levy of the charges on non-maintenance of the minimum balances, whether that is being correctly charged and computed by the bank or not. This point was highlighted in one of the large corporate banks that the compliance with this policy was not being done consistently. This is an extract of the current account circular, which Ketan Bhai is mentioning again. When you get this copy, you can refer to this. With respect to your suspense accounts and your other control accounts, at least for long outstanding items, you need to obtain justification for items which are outstanding for more than 1 year and not for 3 years, as referred earlier. This is with respect to your gold, bullion, and security items, whether your gold security are under joint custody or not, whether branch is maintaining all the adequate records with respect to the gold that is being kept in the vault, excess or shortage in the stock, and whether all my stationaries are getting properly maintained or not, because all these are potential items of fraud where wrong instruments can be misused, whether these instruments can be misused by the bank employees and wrongly issued at the behest of the banks. So again, the idea is that to check on the internal controls with respect to these items. Next is on the books and records. It predominantly speaks on the IT structure and IT or on the technology or the core banking that is being used in the system, whether the branch is subject to any IS audits or not, or whether branch is generating any exception reports. Again, when you go to the LFAR complaints, when you're updating this, so you can specifically have a discussion with the management for these items. Next is on the frauds, whether frauds are detected, are properly getting reported to RBI or not, whether suspected cases are being reported to the head office, whether the early warning system that we mentioned, it is working effectively or not. So please inquire with the bank very specifically on these points, and whatever reporting or comment needs to be added, be very, very specific over here. KYC and AML, again, with respect to deposit accounts. So generally, if the KYC AML, there is a central team or a regional team that does this. So if these checks are not being done at the branch, mention it accordingly. But if these checks are being done at the branch, at least ensure that proper KYC documents are taken and proper AML background checks are being run to ensure to establish the proper identity of the borrowers and the customers. And this is the last point where we need to comment on if there are any specific comments in the previous year's LFAR, internal audit, credit account, your stock audit reports, inspection reports. So reviewing these reports is must to ensure that all the comments are getting properly captured. And if there are any open items or open comments, we need to ensure that these are getting properly addressed in the LFAR before reporting in the LFAR. Yes, that's it. Sorry, we had to kind of rush up in the last 10 minutes, but we'll share the circular with you, the presentation with you. If there's anything, please feel free to reach out. And Ketan bhai and anyone, if there are any specific points to be added.
Yeah, so thank you, Jay. I think all in all, it was an excellent presentation. He covered very well all the points. Only 1 or 2 points to be added, looking at time and respecting the time. See, number one, guidance note appendix, it is having management representation letter, requirement letter, and the divergent which Jay referred are given in this part of the guidance note. Please download that. Also, the WIRC material on bank audit around 150 pages, 200, because 1000 pages of guidance note may not be useful or not practically possible to use it during this short time of this. And I'm happy to share that one of 2 of our study circle members are contributor to this guidance, this update of WIRC. So please go through very, very useful publication of WIRC. Our own member Arvind Nagda and Diti Shah, contributor to this publication. The evergreening, he said, I am not talking much, but look at the gold loan specifically, where they are saying bullet repayments are allowed, but actually those are not bullet repayment. They were supposed to be EMIs and converted into the bullet repayment. Such cases are, a lot of such cases are being found. The last point is use technology, like use Excel, use other tools, so that you can do that data mining, and this TXT file can be easily converted. Study Finacle and other software before you go to the bank. So that will be useful, but the time has changed. You need to focus more on the audit working paper, audit methodology, materiality level, and document all of this, because you will have compulsory peer review if you are into bank branch audit. That's the new RBI, the ICI requirement. So please be careful. And last but not least, RBI has issued many show cause to chartered accountant in Mumbai at least, and last year and last year, there have been number of the show cause which are issued saying that so and so were the norms. Why did you not follow them? Why did you not check them? The restructuring, I could have talked, but again time is not there. But look at the request of the borrower. For example, housing loan में वो बोलते हैं हमने SMS भेजा था तो report मंगवाइए. कितने borrower ने restructuring या तो during the COVID, those reliefs were opted by them. एक आपने message भेजा और उसने yes या no किया या नहीं किया. So call for that report of SMS, which they are having, but unless you ask, they are not giving, and they are blindly applying and saying that everybody opted for restructuring. So wherever there is a restructuring or forbearances taken by the borrower, first starting point is their own request. Look at their request, maybe it in the form of SMS also, but that is must. And many places where bank is doing manipulation, they don't have this. They don't have borrower's request. They don't have such reports, and either those reports are there, you see that they are generated from the system. Again, otherwise they can manipulate and take everywhere MR, cover all the oral points which they are giving you during the discussion, note it on a notepad and put it in management representation letter, so that tomorrow if there is any problem and if you have to respond to Reserve Bank of India or DC, you have management representation letter, you have your working paper. Please note that no bank is entertaining after your audit is over. There are cases where auditors, based on receipt of show cause from RBI, have gone to the bank and seek for information, saying that ye de do, account ka statement de do, and they are very politely but bluntly refusing the auditor, saying that audit is over, assignment is over, and thank you very much, but we cannot give you any more documents. So please collect all the document during the course of audit, so that if there is any inquiry, any show cause, you need not again require to go to the bank. The LFAR, you have to give the account of the list which you have verified, like top 10 standard account and all those things. So please read this new LFAR very, very careful and do your document and verification based on this new requirement. And I thank the Dadar East for giving me this opportunity to chair the session. In fact, it was not much needed and I thought there is no need. And in fact, Jay had put a bouncer in between, but unfortunately at that point of time, I was on a client call for 5-10 minutes and I could not attend the session. So my apologies for that. And once again, thanks to the entire team of Dadar East for giving this opportunity to me to chair this session. And thanks to Jay for an excellent presentation and hearty congratulations. The way he has presented, it was wonderful. And I think we have one more brilliant speaker to whom we can, tell to the other study circle also, those who are asking for the bank branch audit, there are limited speakers available and there is always a shortage of speaker. So we have now a, fantastic speaker in form of Jay. So my compliment to you, Jay, and thanks to the Dadar East team. Over to Parin.
No, just Parin, just 1 minute. Thank you.
Thanks a lot.
Parin, just 1 minute. Thank you, Ketan bhai, for all the
Yes, yes. Continue, please.
Fantastic inputs. Just as Amit rightly mentioned, your experience has come handy over here in terms of giving your inputs. Thank you for all the compliments. And although we were short of time, at least the presentation that will be circulated, it will be helpful. Thank you to Dadar East CP Study Circle, Amit bhai, Parin, Mehul bhai, and to our President Rahul bhai. Thank you for this opportunity. Look forward.
Thanks a lot, Jay. Thanks a lot, Ketan bhai, for your. So I would like to say that both the speaker and the chairman has played a fantastic 2020 during this, we can say, IPL season. That because bank audit, we always used to mention that it is a 2020 thing. We all have to be on the front foot. We all have to be the branch, out branch, when we are dealing with the branch personals. So I would like to say that yes, it is the day by day, as Ketan bhai and Jay mentioned, it is getting very, very riskier, and yes, and of course, where there is human intervention, there will be some sort of what we can say is evergreening, or we can say is the manipulations, or basically saving the accounts for not being getting NPA and all those stuffs. After all these regulatory things and this coming into play, still there are chances that there may be some instances which we may find in our audits. I thank Ketan bhai first for accepting our request to be as a chairman on this forum. He has been a past convener for us and has always been a very instrumental for all of us, and a great speaker on bank audits, we all know. I thanks Jay for leading this session, and yes, of course, Jay has made us excellent PPT. So that's what Ketan bhai also mentioned, that yes, he has played a master stroke today, and yes, we look forward for many more bank branch audit sessions with Jay. I thank Jay also on behalf of Dadar East CP Study Circle for being on this forum and enlightening us with all the changes and the new nuances of the bank audit. Thank you very much. Thank you, everyone.